And honestly, this is where things get really, really interesting. This is the most powerful part of the cake while you own the property. We're talking about the paper loss, and it's all thanks to a wild concept called depreciation.
So, what on earth is depreciation? Well, the IRS basically lets you deduct a phantom expense every year for the wear and tear in your building. And here's the key: it's a non cash deduction. You don't actually spend a dime, but you still get to claim it as a loss. This is what completely severs the link between the actual cash you're making and what the government thinks your taxable income is.
And the math is actually way simpler than you think. You just take the purchase price, let's say 100 grand. The IRS says land doesn't wear out, so you subtract that value. That gives you what's called the depreciable basis. For a residential building, you just divide that number by 27.5 years. And boom, there's your number. In this case, it's $3,454. Now think about that. That's a deduction you get to take every single year for almost 3 decades without spending one extra penny.
And here's where the magic happens. Let's say after you collect rent and pay all your real bills, you've got $2,000 of actual cash profit in your pocket. Great. But then, for your taxes, you subtract that phantom depreciation expense of over $3,400. All of a sudden, you have a taxable loss of almost $1,500. Let me say that again. You made money, but your tax return says you lost money. That is the power of a paper loss.